Imagine this. You're sitting at home, checking your bank account, and you realize something. Your savings aren't growing. In fact, with inflation, your money is actually losing value. Now imagine instead that your money is working for you, growing quietly in the background, without you needing to monitor it every day. Sounds like a dream, right? Well, that's exactly what index funds can do for you. Let me tell you something fascinating. Did you know that Warren Buffett, one of the richest investors in the world, has recommended index funds as the best investment for most people? He once said, "A low-cost index fund is the most sensible equity investment for the great majority of investors." That's because index funds make it easy to grow wealth without the stress of stock picking or constant monitoring. So, what exactly is an index fund? Think of it like this. It's a basket of stocks that mirrors a specific market index. For example, the S&P 500 index tracks the 500 largest companies in the US, including Apple, Amazon, and Microsoft. When you buy an S&P 500 index fund, you're buying a small piece of all those companies. If they grow, so does your investment. If the market dips, so does your investment. It's simple, diversified, and designed to follow the market's long-term growth. Now let's be real. Most people don't have the time or expertise to pick individual stocks or time the market perfectly. And the truth? Studies show that most professional investors fail to beat the market over time. That's why index funds are so powerful. They allow you to match the market's performance instead of trying, and often failing, to beat it. But let's talk numbers because that's what really matters. The S&P 500 has historically averaged about 10% annual returns over the long term. That means if you invested just $10,000 and left it there for 30 years, it could grow to over $174,000, all without you lifting a finger. And the best part? Index funds are cheap to own. Unlike actively managed funds where you pay high fees to fund managers, index funds typically charge less than 0.1% in fees. Over time, lower fees can save you tens of thousands of dollars. Now, you might be thinking, what's the catch? Well, there are a few downsides. Since index funds mirror the market, you won't outperform the market. If the market is down, your fund is down too. Also, index funds lack flexibility. You can't handpick stocks. You're buying everything in the index, good or bad. But here's the thing. You're trading off a little flexibility for simplicity and consistency. Let's talk about how to actually invest in index funds, especially if you're a beginner. Step 1. Open a brokerage account. You can do this with platforms like Vanguard, Fidelity, or Charles Schwab. It's quick and straightforward. Step 2. Deposit your money. There's no need for a huge amount to start. Many index funds allow you to invest with as little as $50. Step 3. Choose your index fund. Popular ones include the Vanguard S&P 500 ETF VOO or the Fidelity Zero Large Cap Index Fund FNILX. These funds track the market and charge very low fees. Step 4. Set it and forget it. Make it automatic by scheduling regular contributions, whether weekly, monthly, or quarterly. This strategy is called dollar cost averaging, and it takes advantage of market ups and downs over time. Now let me share a quick story. Meet Sarah. She started investing just $100 a month in an S&P 500 index fund at age 25. By the time she turned 55, her investment grew to over $350,000. She never picked individual stocks. She never stressed over market crashes. She just stayed consistent. And now she's on track to retire early. But what if you're someone who loves picking stocks and actively managing your investments? Here's the thing. Index funds aren't just for passive investors. You can use them as a foundation for your portfolio while taking small, calculated risks on individual stocks you believe in. For example, keep 80 to 90% of your portfolio in index funds and use the rest for higher-risk bets like Tesla or emerging tech companies. Now, before we wrap up, let me leave you with one last thought. Investing isn't just about making money. It's about buying back your time and your freedom. It's about building a future where you can spend more time with your family, travel the world, or pursue passions without worrying about money. And if you're ready to start that journey, don't wait. Open your brokerage account today. Pick a low-cost index fund, invest consistently, and watch your money grow. If you found this helpful, make sure to like this video, subscribe to the channel, And hit that notification bell so you don't miss our upcoming content where we dive even deeper into personal finance and investing strategies.